Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm Paul Peebles, National Underwriter at Old Capital. With me today is Michael Becker, Senior Director at Old Capital.
Hey, Paul, how are you?
I'm doing great, Mike. I am excited to have Rupa in our office to be interviewed. She tells a great story coming out of the high-tech industry now that she owns a couple apartment buildings. She really has a good perspective of how she made that transition, and we'll kind of visit with her in the interview. But first, being bankers, Mike, people ask us all the time how to get involved. How do I buy an apartment building? And so sometimes you can do it by yourself, but most of the time you need a partner. And you may not just need one partner, and you may need 2, 3, 4, 10 partners, however many partners you need. I think we're going to be talking to Rupa a little bit. She tells a good story about being a partner, and I want to kind of focus on being a partner. So, Mike, give us a little bit of perspective about being a partner.
Yeah, Rupa, in her first transaction, she was not the lead investor in the deal. She was brought in kind of late in the game. The lead investor in the deal had the property under contract, and, we're trying to get the financing and couldn't get it done. And Rupa came in and kind of solved everyone's problems, and we're able to successfully close a deal. And, as you'll hear a little bit later, that's turning out to be a pretty nice project for everybody involved. Partnerships are, one of these things that when you're looking to, first off, get it awarded a contract on a property, a lot of times the sellers want to know who are the partners, what are the financial strengths behind the deal, and what are the experience, and your banker's going to want to know that as well. So when you're really putting these deals together, a lot of people kind of starting out, they may have a lot of money but not a lot of time, or vice versa. You may have time and you want to be the lead partner in a deal, but you don't really have all the financial backing to buy the whole property together, so you need some equity and financial partner to help you get the deal done. Really, when you're out there looking to buy a deal, think more than what you can afford on your own. Think about trying to utilize partners and forming partnerships together, so you guys can kind of pool your resources together, both financial, time, and experience, and then go out and a lot of times you could buy a bigger property that's more efficient and produce a better return when you do it that way. So I think without much further ado, let's start today's interview with Rupa. We'll see you guys on the backside to recap.
Hey, Rupa, thanks for joining us. We appreciate that. So Rupa is here. She owns a property or two here in the Dallas-Fort Worth area. Everyone knows we kind of start at the end to start the beginning. And Rupa has a property of 90 doors and a property of 32 doors. Welcome to the podcast, Rupa. Thanks for joining us.
Thank you for having me. It's a pleasure to be here.
Thanks. So I'd like to try to have everybody meet Rupa. Rupa, tell us a little bit about how did you get into multifamily and what's your background?
First, I'll say I didn't know anything about multifamily when I started. I didn't even know it was a possibility. It wasn't something I looked into. My background's in IT. I was a programmer for a long time, and before I started real estate, I was a consulting director at Oracle, IT practice. I managed my own consulting practice, had a team of up to 60 people at one point. I was just having a bad day one day, and a little while before that, somebody had mentioned real estate investing. They had some rental houses. Mm-hmm. So the day I was having a bad day and somebody was kind of not very nice, and I said, you know what, I don't need to take this. Let me see what else I can do. Let me look into real estate investing.
Sure.
And it so happened that there was a seminar locally that was available. I went to it, and it sounded like something I could do. With an IT background, I'm very methodical, very procedural.
Sure.
And it seemed like it was something doable. And
so you had an opportunity, you went to the seminar. They probably talked a little bit about all the different types of real estate out there. And some people who are not familiar with real estate go to the single family route. Did you go the single family route right from the beginning?
I did not. I considered it, but for me that wasn't an option. I wasn't really interested in starting small at that point in my life. I felt that to have the cash flow that I wanted and the returns that I wanted, I would have to do too many single family homes, and I didn't have the time to go through. Didn't want to spend the time to go through a lot of closings and a lot of different places. So, and cash flow wasn't as big a concern for me as much as capital growth.
Yeah, so you who are not only an expert in IT business, but you're also good at the stocks and the bonds and the options. And so you saw the opportunity that real estate possibly could afford you a hard asset. You're buying a hard asset. I mean, when you drive down the street, you can't look at a stock or an option trade. You can only see a hard asset, and that's real estate. So with the hard asset you wanted to buy, multifamily was probably the first option, what you're saying, and that you took the courses, you learned a little bit about it, and from the period of time that you took the course and you started to build relationships and you got into your first transaction, how long of time was that?
That was about 9 months.
So 9 months. Mm-hmm. So you did research and you did networking and you built your base of knowledge up during those 9 months. What were some of the things that you were focused on during those 9 months that gave you the ability to actually look at doing a deal?
First of all, I think that 9 months was actually a little bit longer, but since the time I started looking into it, I wasn't spending a lot of time because I was still working full-time at Oracle at the time.
Okay.
And my job gave me some flexibility, but not a whole lot of time. So from the time that I actually quit my job to be able to find the time to analyze the deal was actually 6 months. And so I, again, educated myself, but I realized that I'm not going to have all the answers. So I just needed to know enough to know what I don't know, where to go get the answers.
What were some of the things that you were looking for?
In terms of...
did you look at property management? Did you look at structuring the entity? Did you look at management companies? Did you what kind of things that you wanted to learn that you thought were important for you to own real estate?
So the first thing I wanted to learn was to analyze the deal. So
the analysis of the deal.
Yes.
Is it a good deal or is it not a good deal?
Mm-hmm. Okay. Financially, what makes sense? Is it a good price? Is it not? What can I do to the property? What kind of things I can do to improve the property?
So with your financial background, you were looking at price. What was the value? Was the value reflective of the price?
Correct. And what can I do with it?
Sure. Okay. And so it took you about 9 months, and the first transaction you did, it was called Pioneer Villas. Tell us a little bit about Pioneer Villas.
So in case of Pioneer Villas, I was a key principal. I was not the lead investor on this particular property.
So what that means is that she was not the managing member of the entity. So she joined an entity that was purchasing a property over in Arlington, Texas for 90 doors, and that managing member that was buying the property needed help, financial help, not only with the money going into the entity to fund the transaction, but also needed financial strength of a guarantor that had a pretty decent balance sheet. So you, the managing member who also signed too on the loan, and how many other people signed?
I think there were 4 or 5 other people who signed that one.
So everyone pushed up their financial statements to the lender for the lender to review, and you guys bought this property. So that's the bottom line, but let's kind of walk backwards just a little bit. What did you guys buy the property for?
That all in for that property was $2,010,000.
So 90 doors at $2 million or so. And how much work needed to be done to the property?
That one was what's considered a value play, so it did have quite a bit of component of rehab. The purchase price was $1,700,000 roughly,
okay,
and the rest of it was rehab.
So $1,700,000 actually was the purchase price. Correct. Plus $300,000 worth of rehab dollars into the property. Okay. And how did you guys find this property? And what was the background of the property?
That was REO asset.
Okay.
It was bank owned at the time.
So it was owned by the lender.
Mm-hmm.
Okay. And so you guys put your acquisition group together. They had a managing member. You were kind of right below the managing member because you had a large balance sheet. A couple other people had balance sheets. And then you all threw in money to buy the property together. Okay. And now from the period of time that you guys took the property under contract to the time that you closed, how long of a time frame is that?
I think it was About 45 days.
About 45 days? And what kind of due diligence did you guys do on the acquisitions team? Did you guys have a property inspection to be done on the property?
Yes, we did. Before we even got to that point, we did a market survey to make sure that the property was going to have the additional value that we were looking for, that we were basing our pro forma on. And then we did have a property inspection done by a trusted vendor.
Okay. So they went all through the property. They took a look at some of the interiors of the property. They took a look at the mechanicals. How's the HVAC? How's the electrical system doing? They put probably cameras down the sewer lines to make sure if there's any cracks in the sewer lines. So that inspector, which is kind of a unique inspector, that's the one you'd have to find that does multifamily. Because a single-family home person as an inspector is not the right person for a multifamily home. Would you agree with that?
Yeah, definitely.
And so the multifamily person is going to do a pretty strong analysis of the deal. They're going to walk all the units, take some pictures, kind of give the potential buyer some feedback on what this property looks like and what it's going to need. So he put together a report. They usually took him probably about a week and a half, 2 weeks to get the report back. And then during that period of time, you guys were doing some market studies of how rents looked in the area.
Correct.
And that looked pretty attractive to you?
Correct. We also did a lease audit and made sure that the numbers that we were projecting would be accurate, and to see what we needed to do with the tenant base and if there was anything that we needed to do to change out operations.
So after you guys took over the property, what are some of the things that you guys fixed on the property?
On that property, we had a couple of down units, but really it was in not that bad condition physically. We spruced it up a little bit. We added solar screens, made it look better, a little bit of landscaping, added soccer nets because of the tenant base, but mostly it was operational.
Did you guys have a pool on the property?
No, we didn't.
But you had a soccer field, so that was a good amenity to the property.
Correct.
You blacktopped the parking lot and you restriped it?
Yes, we did, though.
Okay. And this property is off a fairly busy street, so marketing really was important, and the property got a new sign and a new name.
Correct.
Why would you remarket an old property with a new name?
Well, a couple of reasons. One is the old name had some negative association to it. There was some reviews online that wasn't very positive. And then also the tenant base that we had was largely Hispanic. And so the whole Pioneer Villas, the Villas adds a little bit of that Hispanic touch to the name.
So you changed it, your group changed it from Matlock Place to Pioneer Villas. So you rebranded the property and you did a launch of the property. And you had people over there, and you had hot dogs and balloons, and you kind of brought the feeling of a community to the property.
Correct.
Okay. So let's kind of look back. When you guys acquired the property, what was the occupancy of the property?
When we went under contract, it was a little bit over 70%.
Okay. That's 70% of people actually living in the property. Any idea what the economic occupancy of the property, which means that it's easy to fill the property up with bodies. The tough part is making sure you can collect rents from all these people that are living on your property and that you're not having to support them. So I'm going to probably imagine 70% physical occupancy will probably be about 50 or 55%. Because sometimes you take over an REO property, the management company that owns it or is managing the asset is just putting Band-Aids on it. And they're filling the property up for sale. So they may not have the highest quality tenants on the property. And so the new group that comes in has to kind of figure out, kind of fish or cut bait. Do these people, are they the model of the tenant that we want to have in the property, or do we have to kind of fire them from being a tenant of ours? So from that period of time that you acquired the property today, what's your occupancy right now?
We are at 95%, and we're pretty much almost always 100% pre-leased.
Okay, so from the period of time that you guys bought it to today, and you guys bought it in July of 2012, and to today we're during the fourth quarter almost of 2014, you're up from X to Y and done a great job of kind of putting Humpty Dumpty back together again. So What's your game plan on this property? What are you guys going to do?
We're in the process of refinancing the property. When we purchased it, it was a regional bank that provided the financing for it, and now we're going over to a Fannie Mae loan, which...
And what type of financing, and if you remember, this was, say, 2+ years ago, what type of financing was approved for a group that maybe had no experience of owning multifamily properties? Do you remember what the bank gave you for terms and amortizations and things like that?
Yes, that was a 20-year amortization, 4%, but it was an adjustable rate. So
adjustable rate. Mm-hmm. So that loan probably did not have a prepayment penalty, so it could be paid off at any time.
Correct.
And that 20-year amortization, so again, these are not home loans, these are commercial loans, and usually commercial loans have shorter amortization. This is a balance sheet loan for the lender, so they're trying to reduce the risk as short as possible. And this was a 5-year term?
Yes, it was.
5-year term, 20-year amortization, a rate around 4%, no prepayment penalty. And then you had, 6 months, 12 months of interest only during the rehab?
12 months.
So you had 12 months of interest only during the rehabs, and you were putting Humpty Dumpty back together again. The bank wasn't pushing you to try to rent the property out as quickly as possible. You were doing it with a plan in mind that you didn't have to push everybody out to get it and do the rehab as quickly as possible. You were judicious in putting the repairs to the property. So I got that. So now you're going to go to a Fannie Mae loan and tell us a little bit about, again, why you guys have decided to keep the property for next year or two or so, and you thought the best idea was to do a Fannie Mae loan. And again, why are you doing a Fannie Mae loan?
So we first of all did vote on keeping the property because if we were to sell it, we feel that the market currently may not provide us good opportunities for purchasing another property.
That is a problem that a lot of people have, is that if you're selling a property right now into the strength of the market and you want to exchange into something else, there may not be a lot of inventory that's available. So that's the ownership and the managing member and Rupa felt that they wanted to keep the asset so they wouldn't have to sell it and try to find another replacement asset.
So we decided to refinance to get as much as our money out. We're going with the Fannie Mae loan, which will give us 75% loan to value. And because of the changes that we've made and the operations improving, the value of the property has gone up quite a bit. And so the loan is now based on a $2.75 million property.
So you guys bought a $170,000 to $300,000 worth of hard repairs to the property. It's been generating a rate of return, a yield back every quarter or a month. You guys get a dividend check?
A quarter.
You get a check in the mail for the proceeds on the percentage, I guess, the pari passu based on the amount of money you guys put into it. Gives you a rate of return on your money. And now you're looking to refinance it at 75% of the appraised value. So you guys are thinking about trying to get out how much in cash?
The cash value is going to be almost, including the returns, we're going to get about 100% of it. So we put in $840,000 that we brought to table, and including the distributions, we're looking to get 100% of that back out.
So a matter of less than, say, 30 months or so, you guys are you've already got a rate of return, but you're going to get your money back too.
Correct.
All right. I like when a plan comes together. And so we helped Rupa on her original transaction, and we're helping her now on the Fannie Mae loan too. So let's go to transaction number 2. You had your experience. Now you're going from being the first officer on the airplane. Now you're the captain. So tell us a little bit about transaction number 2.
Transaction number 2 was a lot of fun because I was the managing member. I know a lot more about the financials in that one, and it did cause me a lot more sleepless nights than the first one. So I wanted to start out small. I'm a very conservative investor, so as a managing member, I wanted to start out small, even though I did have experience with the 90 unit, but I was in charge of this one. It's going to be my neck on the line.
That's right.
I wanted to start small. This particular property, they had some rehab component. It wasn't necessary. It was what we wanted to do to change the property and the types of tenants that we wanted to have. But It wasn't necessary.
So let's kind of go through the second transaction that Rupa now became the managing member is a property called Villa Valencia. And what was the original name of the property?
Irving Court.
Irving Court. I'd rather live at Villa Valencia than Irving Court.
We actually had some people who got calls from Irving Court and thought that it was the court calling them, so it was almost necessary to change the name.
That's funny. And so it's 32 units, and you guys bought that when?
That was in May of 2013.
And the seller on that property, was it a local seller? Was it in default? Tell us a little bit about it.
It was not in default. It was a seller from California.
Okay, so an out-of-state seller that owned a small little building. Now, let's change hats for a second. If you owned a small little building in Southern California, as an example, let's just kind of role reverse. How difficult would it be for you to try to own a 32-unit building? You're living in Texas, or in Dallas specifically. Now you have to own a building in Southern California, 11, 12, 1,300 miles away. How difficult would it be for you?
For a 32 unit, it personally would be very difficult for me because I'm a very involved investor, and in fact, this particular owner had a lot of challenges. They had people who were stealing from them, property managers who were stealing from them. So I would say, at least for property of this size, it is difficult for me personally.
Yeah, well, I would think, for everybody, just the economies of scale, 32 doors, you're living someplace else and you're trying to manage it at a distance, and you maybe make a trip to the location where your asset's at once a year, once every other year. You really have no idea what's going on, what the property looks like. You may see some pictures, you may see some financial statements, but you really don't have a feel about what's going on and what's going on with the neighborhood too. So I think it's important when you own some of these smaller buildings that you live, work, and play around your asset. So let's kind of talk more about, you guys bought it, 32 doors, Villa Valencia, now it's called. And what did you guys pay for the property?
$1 million, including $95,000 in rehab.
So $900,000 worth of acquisition price, $100,000 or so with rehab dollars, all in. And now you had a little bit more experience. Now, since you ran the show, what did the bank give to you in terms of loan to cost?
We put in 25% down.
Okay.
And the rest of it was bank, including rehab.
So you did the all-in price. So you did 75% of the acquisition price plus the rehab dollars.
Correct.
All right. And did you get some interest only on that too for the rehab?
Yes, we had 1 year of interest only.
Okay.
And we decided to go with a 5-year loan at 4.35%.
So you got a fixed rate.
Yes.
At 4.35%. And how long was the amortization on this one?
This one was 25-year amortization.
So the more experience you get, I'm going to just start making some generalizations here. The more experience that you get, the more flexibility you have with different loan programs and options. So the first one, Pioneer Villas, Fannie Mae was not going to allow you to jump in and do a loan with Fannie Mae right at the beginning because you had no experience. The second one is the bank, which was probably, I think, the similar bank to the Pioneer Villas was, is that they saw your experience. They saw that you took care of the property, you were kind of putting the asset back together, and you started to stabilize it. So they felt, well, now we have a history or a track with Rupa that we understand, and we want to be in partners with her. So just like partners, the managing member put some money in, then you also had some additional partners too. How many did you have on Villa Valencia?
We had 3 other partners apart from my husband and I.
So you had 2 other partners sign on the loan, and then you had, or is it just you that signed the loan?
It was just us who signed on the loan.
Okay.
We were just truly passive members.
Okay, so the 2 other people that were in the entity, but they didn't sign on the loan.
Correct.
Oh, okay. So tell me a little bit about the property. What occupancy was it that you guys bought the property for?
So that was funny because when we went under contract, It was at 100%.
So they say.
So they say physical. However, by the time that we were getting close to closing, it was down to 90%. And as we were looking at the leases, it started to look that we were going to go down. But we reran the numbers and felt that it still made sense. It was just because it was mismanaged and we would still do better. And so we decided to go ahead with the acquisition.
And how did you guys manage the asset? Did you have a third-party management company on this property, or are you able to, because it's 32 doors, were you able to manage the property by yourself?
This particular one, I'm managing the property myself with my management company.
So you formed your own management company. And we didn't say, but in Pioneer Village, you had a third-party property management company?
Yes, we did.
And this one, since you had a little bit of a track record, the lender, the bank, was able to let you kind of run your own ship, is that they let you form your own management company, so you were able to have a manager on site that was responsible to you, and you were responsible to get all the financials put together for the lender.
Correct.
Does the lender ask for your financials now after the loan closes? They ask for them on a quarterly basis, a yearly basis. How many times will they ask you for your financials after loan closes?
After loan closing, it's once a year, and the lender, yes, asks for a lot of details financially. They know more about it than my parents.
So tell me some of the things that you did on Villa Valencia to improve the property, to bring the occupancy up, to keep those tenants in the property.
Right. So we really didn't have to worry about occupancy very much. What we needed to worry about was the type of people who were living there. We did go from, when we closed, pretty close to 90% physical occupancy all the way down to 66%.
Wow.
And I had to bring it back up. But we are currently almost always at 100% occupancy. The only time we have a unit available is when we're working on a make-ready on one.
And how is the city to work with?
The city is great. City of Irving is familiar with some of the other investors that we've worked with. And ahead of time, I had given them a call, letting them know what we intended to do with the property.
Great attitude.
Yes, and they have been very, very supportive of the changes that we've made to the property.
Yeah, I mean, there's nothing of communication between the city and whoever the government authority is that oversees properties for some of these small towns, to kind of introduce yourself to them so they know who they're dealing with directly. There's been too many investors who have been outside the state or just never see their property, don't care about their property. They just see these things as glorified ATM machines that they don't put any money back into the property. So the cities are really anxious to meet and get to know the people who live and work and are a bigger part of the community around here.
And that was really important in our case because we did go through some challenges where we had a change of property manager and the property wasn't doing as well as we had been doing, but the inspector that's assigned to us realized that that's not how we do business normally, and it's just an exception, and was very accommodating to us.
That's great. Now, you guys bought this in May of 2013, so 18 months ago or so. What's kind of your game plan right now? I mean, are you guys going to keep the property? What's the future for Villa Valencia and Rupa?
Yeah, as of right now, we are planning to keep the property. However, based on current financials, a little bit over a year later, we're already pretty close to $1.3 million in valuation.
Wow. So
we are open to selling it if we're able to find another property and the timing works out.
So all in, you guys were at $1 million. And because the NOI has gone up, you're valuing the property based on a cap rate of
8.5.
Wow, that's pretty conservative. I mean, it's probably closer to maybe 8 or so. They give us a 1.3 valuation. I mean, that's dynamite. So really, when you do go to sell the property, you will get rewarded on the property, and it's a good asset, and it's a clean asset. You've really made a difference in a lot of people's lives that lived and worked around that area. I mean, this is their home. and everyone wants to be proud of where they live. And I think that you've done an excellent job. I've driven the property since we made the loan on the property, and you trimmed the trees, and you've done an excellent job kind of putting another Humpty Dumpty back together again. So great job. What's on the horizon? Where's property number 3 coming to come in?
I am actively searching for property number 3.
Yeah.
This would be my second as a managing member, looking for something at least 75 units or so.
Right. So you're looking for between 75 and 150 doors in the Texas area?
Yes.
So your goal right now is refinancing Pioneer Villas, pulling some cash out, number 1, keeping Villa Valencia and just getting that property cash flow. And then property number 3 you're looking for, and that's really been the challenge for a lot of people that are looking to buy properties, is that not a lot of inventory out there to buy. So if we were to kind of reverse roles and you were talking to somebody that was your best friend today, if they were thinking about getting into the multifamily business, any things that you'd want to share with them that you have found to be challenging that you were able to overcome? Or just, what do you think about this business? Do you think you're going to stay in it?
I am definitely going to stay in it. There's a formula to it that you can follow, and for me that's important. There is a spreadsheet that's very helpful, and just don't panic. You realize that you're not going to have all the answers. Figure it out. I did run into drug dealers on the properties,
Wow.
on the property, and we had challenges, but it's something that I will continue to do.
Well, that's great. Anything more you wanted to add, Rupa? Is there anything else that we should talk about?
We talked a little bit, we touched a little bit about some of the other investments I do, and as you know, that there's a big benefit of doing real estate for tax purposes, so that's a major consideration of why I do this as well.
Okay, sounds good. Rupa, we so much appreciate your time, and I wish you a lot of luck. We know that you'll do real well in multifamily investing, and hopefully we'll talk to you after you acquire property number 3.
Which will be soon, I hope. Thanks for having me.
Thanks, Rupa. Appreciate it.
Hey, thanks, Paul. It was a great interview with Rupa. Rupa's got a good story, and what I kind of took away from it is what it's like for her to transition from having a full-time job and being in the tech business, and now trying to go into full-time real estate investing.
Now, Mike, you own 1,000 doors plus. Did you do it by yourself, or did you have partners?
No, I like Rupa. I couldn't do this all by my own. We own several apartment complexes, and I certainly don't have all the money in the world. So having a good group of partners, and in my case, I'm the one out there owning and operating, and then they're more the investors. But I certainly couldn't do it without partners, and I think it's if done correctly, and and everyone's up front with everything, and everyone's on the same page. Partnerships are really a powerful tool to grow and expand in this business and do more and bigger deals than you could ever do on your own. So I really want to thank everyone for listening to today's Old Capital Real Estate Investing podcast. Again, if you want to find out more information about us, please go to oldcapitallending.com, and there you can find out how to contact both Paul and myself. We'll see you guys here next week with another great interview.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.